study. As you see, we look at the subject of investment trusts today. Just to give you an update, for those of you doing exams, I want to give you a bit of an overview of what these products are. Now, I've been watching these shows on Paramount TV recently where it's all about the American West in the 19th century. And the American West were pretty much in the middle of the country, really, around the Rockies. They hadn't gone from the east across, and from Los Angeles, they hadn't quite got over. There was this area where it was like the Wild West, and it was dangerous, and there was killings and all sorts of things going on. And you had Indians and cowboys and all sorts of people. Now, the reason that they were able to get into the West and establish towns and cities were the railroads. And the railroads, of course, were trains, and they were miles and miles and miles of railways that had to land. And to get the money for those, they got their money from investment trusts. And not a lot of people know this. So this is mid-19th century stuff now. Investment trusts have been with us for 150 odd years. And they were created in the Victorian times when we kind of ran the world, really. And these gave the money for the Wild West railroads. There you go, opened up the West for you. So a bit of information that's not that useful, but hopefully it'll motivate you. So what are investment trusts? Well, investment trusts are a way of investing your hard-earned money, regular contributions or lump sum money, into a collective. So they're a collective investment. In other words, everybody puts their money into a big pot and it invests in many places for you. But the thing about investment trusts is they're very different types of vehicles, because they are collectives, but they're not unitized like a unit trust or an OIC. What they are is they are shares in their own right. So let's just draw a little picture there for you of an investment trust. It's a share in its own right. Now, an investment trust is actually a company. It's a PLC. Because it's a PLC, it's actually traded on the stock market. So it's governed by company laws and all those good things. And it has a structure which is designed to invest money on behalf of its shareholders, if you like. So you buy a share, and lots of people buy shares in this investment trust company. Let's put a company there for you, which has shares which you buy. They are traded on the stock market because they're PLCs. And that's pretty much how they work. So a bit more detail, deep dive into it. So a lot of these people who buy into this investment trust, they pay their money into buy shares, and all of this money goes into the coffers of this PLC. And they then use this money to invest in where they see fit. And you might have different types of sectors for investment trusts. You might have a Far East sector. You might have a technology investment trust. It doesn't matter. They choose where they invest, and you obviously buy the shares of the investment trust company that you would like to invest your money into. So if you think about it, it's pretty clever. You buy the shares, they get traded on the stock market, which means they're closed-ended. You might have come across that phrase before. They call them closed, a closed structure, because once you buy your shares and the company gets your money, and the company then invests your money for you, they then won't pay the money back to you in most cases. If you want to get your money back, you've got to go to the stock market. Let's just put it over here for you. You've got to go to the stock market, and the stock market you can buy and sell your share. In other words, their fund is closed. The money they've got to invest won't need to be shrunk in any way, and it won't expand. It's closed, which means they can take a long-term view on their investments. They don't have to think about investors wanting their money back with OICs, for example, because it's a closed-ended fund. What you tend to get, therefore, is more of a long-term view on investments. You don't tend to worry about them having to keep cash back to pay unit trust holders, OIC holders. They have a long-term view on their investment. Slightly higher risk maybe, but slightly higher return as well. Very popular investment trusts. So how do you buy them? Well, you buy the share by going to the stock market and buy an existing one, or you go to the actual company itself and buy shares directly from them as well if you wish to do so. So you can buy for a stockbroker or directly to the stock market. So you get your apps and you can buy investment trusts that way as well. So how do they work? Well, they're companies with a company structure, but these funds, if you like, these investment trusts usually make charges to you. So when they're buying and selling the shares within the company, they'll pay all the charges that are relevant to that, of course. So dealing fees are added to the the costs, but they also take an annual management charge. So let's just put that up there for you. an AMC, an annual management charge, of anything between, maybe 0.25%, sometimes to 1.5%. And this pays for the managers who are managing the funds, doing all the buying and selling of shares within that fund, within that closed fund. So there's quite expensive charges, but you get good returns on these things. So how then do you value it, and what's it all about? Well, the stock market, of course, will have a price for these shares, like any company. The stock market will determine a price for the shares based upon supply and demand. So if I wanted to buy some British Telecom shares, the stock market would determine a price for me. And again, all these shares from different investment trust companies, and there's hundreds, thousands of them, will be priced accordingly. But more important than that, you need to be able to look at what the share is actually really worth. And what they do in investment circles is they have a thing called a NAV, or net asset value. So let's put that over here for you, net asset value. Net asset value. All shares have a NAV, as it's known as. There, your NAV, net asset value. And what a NAV is designed to do is to show you exactly how much that share is really worth. Okay, the stock market will price it according to supply and demand and sentiment in the future and all that kind of stuff. But the net asset value is exactly what it's worth. And what they do is they value it by working out how much the company is worth. So say, for example, you've got an investment trust company which happens to be a North American fund or whatever. So they'll add up exactly how much every share that they own is worth. So they'll probably own thousands of shares in North American firms. And they'll add them up to see how much they're worth. And then they divide them by the number of shares that they've had issued. So it's the value of the company, if you like, all the investments the company has, divided by the number of shares issued will give you your NAV. And that's particularly important, because that tells you whether you've got a good investment or not. Because the NAV itself gives you an indication of whether the trusts are trading at a premium or at a discount. Now, if they're trading at a discount, let's put this across here for you. If they're trading at a discount, what this means is that the share itself is doing okay. There's a potential for higher returns because the actual value of the share is actually, or the NAV itself is higher than the actual value of the share. In other words, you are getting yourself a pretty good deal and you have a potential for higher returns. If you're trading at what they call a premium, that means that the NAV itself is actually higher, or I should say, in other words, the price of the stock market that you're getting, you actually are paying more for your share than the actual value of the company itself. So trading at a premium then means the shares might be overvalued. That's what they're saying. So your NAV itself will be less than the value of the price of the stock market's given you for you. But if it's trading at a discount, the NAV itself is probably higher than the actual price in the stock market. So really, if you put it at discount is good news, the premium might be bad news because it might be overvalued. So that's just how they tend to operate with trading at NAVs. That's something to bear in mind. What else is important about investment trusts? Well, the next point is gearing. This, remember, is a company. It's a PLC, and it's running a fund, if you like. Now, as all PLCs, they can borrow money, or they can do what's called gearing. They can borrow money from the bank, if you like, in order to expand their coffers, in order to buy more shares and do some more dealings. Now that's a particularly useful advantage of an investment trust. OICs and unit trusts can't do that. Now because they are borrowing, they're kind of amplifying a rising market. So if the market's rising, you can amplify your returns. But if the market's falling, then you can have increased losses. You still got to pay the interest to the bank, but you might make some good deals from the investments that you've used by borrowing money from the bank itself. Taxation, so let's get a different colour pen then, get a red pen for taxation. Very similar to shares, so if you understand how shares are taxed, you won't go far wrong with this. Now the money that the investment trust makes, they have to pay out in dividends. They have to pay dividends, of course, to shareholders, just like any other share, and they do have to pay 85% of the money they make from the shares that they buy and sell, dividends that are paid out from those, they have to pay out at least 85% as dividends. And that's taxed in the same way as all dividends are with shares. So capital gains tax, though, there's no capital gains tax for them to pay, for fund managers to pay when they buy and sell shares. That's important because they're a company, aren't they? But if you sell your share on the stock market and you've made money from that, you have to be paying capital gains tax. Unless, of course, you wrapped it in an ISA, when, of course, the tax returns are tax-free, capital gains tax purposes. So if you understand shares and how they're taxed, an investment trust is a share at the end of the day. There's no big difference. Final thought for you, we'll pop this one in blue over here, is you can have what they call split capital investments. Now, if we have splits, we're running out of room on this this whiteboard, aren't we? But if you have a split investment trust, it means that you can decide whether you want lots of income or lots of capital gain. And the way they work is that if you want to have all income, you have a split capital investment trust which pays just income and no capital gain. Alternatively, you might just want a capital gain, so it pays no income, it just gives you a capital gain at the end when it comes to maturity, when they pay out. That's known as a split capital investment trust. Or you can have a balance, in other words, you can have the two. So you might want to have an income share which pays you lots and lots of income but no capital. You're kind of sacrificing capital gain, aren't you, for income. Or you can have a capital share which pays you a capital gain at the end but no income. Or naturally you can have a balance. Let's put that one in there for you as well. And the balance itself is income and capital gain. So a few complexities going on there. They're very popular with IFAs who recommend investment platforms and wraps for clients. They perform very well. Their charges are reasonable compared to maybe some other type of products as well. They are actively managed, so they're not passive at all. So they're active management, so you've got people doing the investing for you. So if you want an active management investment trusts are a good place to go if that's what you're looking for to enhance your returns. A few things in there in the exam. The NAV crops up. Remember, you value your shares according to what is behind in the company, how much all the shares are worth, and then divide that by the number of shares, and that gives you the NAV. And you can be trading at a discount, of course, which as you can see there is good, or premium, where you maybe are paying over the odds for it. And you've got these split capital shares to think about as well. And that ended that topic. Bye.